Venezuela is not just a geopolitical story. Of course, it's also an oil story. It means big things for companies like Valero, for companies like Baker Hughes, companies like Canadian Oil Sands and Suncor, and it means a huge deal for big players like Chevron. We're going to dive into exactly what this means from the ecosystem for investing in oil, including everything from the refiners at the end all the way up to the people who are punching holes in the ground today on Altimetry Authority.
Let's talk earnings and favorite pastime.
Let me just say,
Wall Street.
It's 2.5x
because their compensation goes up.
Wall Street's wrong again. So, Joel, it would be wild for us to start the year at Altimetry Authority without talking about the most obvious thing that happened, which is Venezuela. And, this is a stock market story as much as political story. And so you want to give everybody kind of lay of the land as we were talking about it in terms of where we think the cards fall, as you may?
So let me get to the numbers, right? This, without getting into the politics of it, we had a country that has some very big oil reserves. I'm not going to say the biggest in the world because that you would take issue with that, right? But they have some very big oil reserves.
Really.
It's not.
And for everybody, for context on that, right? Everybody talks about whatever the number is, that it's bigger than Saudi Arabia. That is entirely from the Chavez regime, right? The regime before Maduro and everything else. That was entirely a propaganda exercise for them to make PDVSA, the Venezuelan oil producer, say, hey, we have the biggest reserves and everything else. That was never the case beforehand, but that doesn't matter, right, Joel? I mean, the biggest reserves versus not is irrelevant because...
Yeah. If we look at just production, prior to Chavez, right, when you did have the U.S. oil companies in there, and you did have, no sanctions and friendly trade, if you will, they were doing 3 to maybe 3.5 million barrels of oil a day, right? And with all the sanctions that come on and the utter mismanagement and the outright theft, which did happen, of U.S. equipment and property that had been, massive amounts of investment went in, that, and honestly the sanctions as much as anything else, and they're down to less than 1 million barrels a day. Some days you might even say maybe even just 600,000. So the big thing that is going on now is if we get into a situation where the government says we're going to be friendly to the West, we're not going to keep doing things that anger the U.S., we'll play along, and the U.S. says, all right, we're going to lift sanctions, forget about the 50, 60, there's been reported that 50 to 60 million barrels of oil that's out there that they kind of took, that the U.S. has taken. It's that if Venezuela is back online the way it used to be, you're talking about potentially another 1 billion barrels of oil per year going onto the market. You're talking about another 2.5 to 3 million barrels. Again, it's not going to be tomorrow or next week, but that's what you're getting to because they were there already before and they can get there again. And if that happens, you're looking at global oil prices coming down a lot. That's the price of gasoline. That's the price of all kinds of products that's the price of, a ticket on an airplane because jet fuel is one of the most expensive parts of an airplane and so flying. So when we talk about that, we have a potential impact on inflation overall that could be significantly good for the U.S. and for the United States in particular. Maybe not for China and Russia because they had been getting Venezuelan oil at a deep discount, which they probably won't be able to get anymore at such a discount. But either way, the U.S. should benefit from it. And this is where the U.S. probably, again, we've talked about how much we don't like the CPI and how the Bureau of Labor and Statistics is notorious for producing bad data. They still seem high on their inflation number, meaning Trueflation, one of the boutiques that we like to look at, is pegging inflation already down to 2%. Now, that's not negative. That doesn't mean prices go back to where they were. It simply means they're not rising as fast as they did. So it doesn't. You're still going to feel it. If you're feeling it right now that things are expensive, they stay expensive. They just aren't getting even more increasingly expensive like they were last year, the year before, the year before, the year before that, right over the last 4 years. So what we're looking at is this Venezuela being very, very positive on creating oil supply that brings down the price. And that means there's some winners and there's some losers. And one of the losers that was obvious to me, Rob, that I'd like you to address is, the countries that produce oil at the highest break-even point meaning the toughest places to dig it out. It's one thing when you're in Saudi Arabia, you just pull it out of the sand. It almost just pops out. But when you're in Canada and you're pulling it from sand, where it is the sand that you're lifting out of the ground, you're not going through the sand to get the oil, you are pulling sand. That's a lot harder to refine and whatever. And they have higher break-even points, which means you might see Canada suffering a lot, both from a oil and gas revenue standpoint, with the prices coming down, but also from a, given that that's their main point of taxation, that the entire Canadian budget and Canadian deficits might get a lot worse too. So there's some obvious winners and losers. Rob, you want to take it?
Yeah, and I mean, and everybody, there's an important, when you look at the impacts of this, it's really good to first understand the ecosystem of how different players in the oil world make money. So if you think, there's the equipment and service providers, right? They make more money when more people are punching holes in the ground, and also when more complex oil needs to be pulled out of the ground and processed. These are companies like your Baker Hughes, your Schlumbergers, your Halliburtons. And if you look at that, just really quickly, Joel, before we get into the oil sands, because I think that this is kind of helpful to lay out the land for everybody. For them, they're going to benefit from this, right? Structurally, what you're going to see is, sure, you might see lower oil prices, meaning some players in the oil market, which we'll get into Canadian oil sands in a moment, everybody, might actually invest less, or some of the U.S. producers, the wildcatters in the Permian and whatnot, might not. But for really complex and really high investment opportunities in oil, you need these players, right? The big three, again, are Halliburton, Schlumberger, Baker Hughes. And if you look at, like, for instance, a Baker Hughes, when we look at it on a uniform accounting basis, has had a really good run in terms of return on assets. The cleaned up way that we understand profitability for the business has been rising steadily for the last few years, and the market's pricing some of that to come in. And so we look at that and we say, hey, for some of these oil field services companies, there might be an opportunity. But then, Joel, to your point, you get to the actual players in terms of the people who pull out oil, right? At the end of the day, when you're pulling out oil, it's actually really simple math. It's how much does it cost for you to pull it out, and how much can you sell it for? And so the issue is, for the Canadian oil sands players, well, if the overall price of oil drops, first off, that immediately hits them, but they don't sell oil at the oil price that we all talk about. The Canadian oil sands doesn't sell at WTI or Brent. They would love to sell at WTI or Brent, but because they have literally, Joel, what you talked about, it's literal sand, everybody. It's called bitumen, is what it's actually called. So it doesn't actually, you have to process it a lot. It's got all these chemicals in it. It's got all of these imperfections. And literally, you have to refine the sludge out to get to anything usable, which most of that happens in Midwest refineries, which is an important point. Remember, Midwest refineries there. There's this, so the issue there is, the price of oil comes down, immediately they get it, but they already sell at a discount to that anyways. And most of these oil sands guys, they're comfortably above $50, $60, $70. It used to be up above $100 that they were actually break even. They're lower than that now. But so that's going to hit them immediately. So if you look at players like Canadian Natural Resources, Joel, or Suncor, why don't you give everybody, Joel, a context? The white bars we're talking about here versus the blue bars, what are we seeing for, say, Canadian Natural Resources in terms of market expectations, and why it doesn't look like the market's pricing in the risk of a whole lot of cheaper oil coming on the out of the ground?
I mean, basically what they're saying is, and of course we focus on the blue bars, that's uniform accounting based, especially with these oil and gas companies, especially when they're exploratory. The accounting is maddening in terms of how sometimes they use historical cost accounting. So it's based on the price of equipment from their depreciating equipment that's 20 years old, and it's based on that 20-year-old price versus something that's happening right now that's based on today's prices. It's really a mess. And then how they do some of the allocation. So when we do uniform accounting, you get a different answer. So the blue bars are different from the orange. And you can see that for this company, right, the blue bars, where they've hit in the last 2 years, is pretty much where the market expects it to stay. So it means they don't expect, right now, the current valuation does not expect that they're going to lose margins, or they're going to start losing from, at least from the levels that they have been in the last couple of years. That the market's pricing in that it's going to be pretty much the same 5 years from now, and in perpetuity as it is today.
Yep. Yeah, and so everybody, right, you look, and this is Canadian Natural Resources, the largest of the oil sand players. Suncor is one of the other big players. They both look the exact same. the market's expecting that nothing's going to change for these businesses. And you look at that and you can say, hey, look, it is obvious then that there's going to be a bigger pressure point here than the market realizes for the Canadian companies, just because of the fact that the price of oil is going to be lower. Now, for somebody like a Chevron, right, everybody knows, I shouldn't say everybody knows, you may know Chevron is historically was a big player in Venezuela. They still have rights to oil in Venezuela. They're actually the only U.S. company that's still been able to work in Venezuela over the last 25 years because they keep on getting exceptions from the rule that you're not allowed to because the U.S. government understood how much investment they had in Venezuela. For them, there is some pricing for return on asset recovery here, right? In terms of, again, those white bars are what the market expects at current valuation, right? At a current $300 billion market cap for Chevron, what the market is pricing the company to do. The market's pricing some recovery from what it's forecast to be last year, but certainly the market's not pricing in crazy boom times like they've had before, if you look. So you look at all that, and that tells you, hey, there might be some opportunity for Chevron. Certainly you want to avoid the Canadian oil sands companies. But there is this nuance, there's this idea that's been out there that part of the reason the Canadian oil sands are going to get hit is because Venezuelan crude is heavy and they're heavy. They're heavy meaning, just for context to step back, in the oil world, you talk about terms like heavy versus light, sour versus sweet. All those are about basically the level of imperfections and the kind of imperfections, right? If memory serves me correctly, sour versus sweet is all about sulfur content. Heavy versus light is about other imperfections that are in the oil. So this idea, they're both heavy and sour, so therefore you're going to see the Venezuelan crude replace the Canadian crude in the refineries. For anybody who's telling you that, they don't actually understand how these things work. Different kinds of oil are wildly different in their composition. Venezuelan heavy sour, totally different from Canadian in terms of what's going on for the oil sands. The same refineries don't refine them. The refineries that refine Canadian is mostly in the Midwest because they've all built themselves. You have to have these complex, what are called crackers, to get rid of the sulfur, all this other technology to be able to process this specific kinds of crude. So you see specialization. And so one of the winners, and it wasn't surprising that they popped 10% on the Monday after Maduro was taken, one of the biggest winners of this is Valero. Valero is one of the largest refineries in the U.S. It is one of the biggest players in the Gulf Coast, and they had made massive investments, especially in the 2000s, of making their refineries ready for Venezuelan heavy sour. They are the winners for this because the fact that the way that refining works isn't just, oh, hey, it's the price of oil goes down. Refiners make money on what's called the crack spread. And what the crack spread is, you often hear it called 3-2-1 crack spread, but there's a number of different ones. But what the crack spread is here's how much I pay for my oil, and here's how much I can sell it for gasoline. So when you think of gasoline, diesel, and jet fuel, and all of the other stuff, if you want to talk about the kinds of plastics or petrochemicals that go into everything from toys to chapstick to anything else, or to anything like that, what you're basically looking at is...
I knew you were going to say chapstick, Rob, because it's very cold in the Northeast.
It's cold in the Northeast. It's top of mind for me, everybody. But so when you look at it, and so for the outputs, there's two reasons why you get pricing for the outputs: for oil and for diesel, for all the other paraffins and everything else, for jet fuel. One is geography, right? In terms of if you have a whole lot of it being produced in that area, right? And for instance, in the Gulf Coast, generally gas prices are lower. And two is just broader, market trends, because you do see some pull up and pull down from the aggregate market. The price of oil is dictated by one, geography, but two, the kind of oil, right? Because you always see that different kinds of oil would trade at a discount or a premium to WTI, Brent, Louisiana Light Sweet, et cetera. The benefit that Valero is going to have here is twofold. Not just that the price of oil is going to come down because of the fact that we are seeing more oil produced if Venezuela ramps up at all over the next couple of years, but also as more Venezuelan crude comes onto the market, it's going to trade at a greater discount to what it currently trades at for Louisiana Light Sweet, WTI, Brent, because if you flood the market and the only people who can refine it are people like Valero, lo and behold, Valero is going to be able to buy an even bigger discount. And that crack spread, right, the difference between the oil that they're pricing and the stuff that they're selling is going to get wider. They're going to make more money. And so there's this nuance that Canadian is going to suffer because the refiners are different. It's not that. It's a pricing story. But the bigger story for the refiners is how players like Valero are going to get a bigger, fatter crack spread than they already do, and higher volumes because of the kind of crude that they refine. And that's a big story here that nobody's fully grasping yet, which is why, I mean, Joel, we're certainly kicking the tires on Valero because even after a 10+% move, the market has not captured just how much we think they're gonna benefit from Venezuela, right?
It could. I mean, it remains to be seen, right? It's still who's in charge in Venezuela, and are they going to really kowtow to the U.S.? But it seems like it's headed that direction, and it seems like everybody wants their oil producing again. The Venezuelan people would benefit if that money didn't go to cartel drug lords and what have you. Not just Maduro, but like the next 9 in line of other big Venezuelan drug lords that are down there, but drug lords and criminal of all kind, money laundering, whatever. But if those people are kept at bay, it'd be good for the Venezuelan people to start seeing that oil pump. And one of the biggest refugee crises in the world. I was in Colombia recently, and when I was in Colombia, the streets were filled with Venezuelan refugees in the worst, most destitute situations. It was just terrible. And yet they were saying they'd still rather have that than be in Venezuela, where it's the difference between, starving or not. And it's very, very sad. So my hope is, out of all this, that there is some monies that go to Venezuela and that eventually go to the right people from all this oil coming online, and we might actually see a little less of a humanitarian crisis that we've been seeing down there that I got to see firsthand just 6 months ago. It was disturbing.
No, it's fair. I mean, look, if we're being frank, there's a whole lot to play out on that side of the equation because the fact that the current people in power are still the same people outside of Maduro. So we can be hopeful on that, but we'll see. But from an investor's perspective, there's a specific set of cards that are laid out everybody here to pay attention to. And one, Joel, to your point, it starts everybody with inflation. Right, this is a huge benefit and an offset on the other areas that we're seeing pressure on inflation, like price at the meter, to continue to be able to keep price at the pump down. 2, what it means for those people who are going to be playing for investing in the oil space. And 3, really specifically, the story is in the refiners, is to pay attention to. So if you're thinking about it from an investing perspective, focus there. We could all be very hopeful on what's happening from a geopolitical perspective, but from an investing perspective, focus specifically in particular on the refiners and the equipment and services companies. That's where the narrative might be, everybody. And if you enjoyed this conversation or you just disagree with Joel and I, drop a comment in underneath this video and hit the like and subscribe button. And that is this episode of Altimetry Authority. Thanks, everybody.
Thank you.